Here is a sentence I never thought I'd say in my lifetime. Grab, the company famous for burning cash faster than a bonfire in a typhoon, just announced a $500 million dividend. The era of the unprofitable super app is officially dead.
Wait, a dividend? Not just a buyback? That signals serious confidence. It's like the unruly teenager of Southeast Asian tech just put on a suit and got a mortgage. Welcome back to Asia Tech Macro. I'm Maya, looking at the maturation of the startup ecosystem. And with me is Alex, who looks confused because his short grab thesis just evaporated.
I'm not confused, Maya. I'm reevaluating. But seriously, the earnings call yesterday was a watershed moment. Grab reported a GAAP net income of $320 million for Q4 2025. Anthony Tan, the CEO, didn't talk about GMV growth or market share for the first time. He talked about free cash flow per share.
It's the Amazon moment. Remember when Amazon stopped being a joke and started being a utility? Grab has effectively become the utility infrastructure for 700 million people. Ride-hailing, food delivery, and now digital banking with GXS Bank finally hitting profitability.
The digital bank piece is key. I saw a note from Morgan Stanley this morning pointing out that GXS Bank's deposit base in Singapore and Malaysia has grown 40% year on year. They are lending to gig workers using proprietary data that traditional banks don't have. That is a moat.
And it sets the stage for the next wave of IPOs. We've been waiting for the next grab. With this news, do you think we'll finally see Traveloka or GoTo make big moves in 2026?
The window is definitely open, but investors are picky now. They don't want growth at all costs. They want the grab model, dominance plus discipline. Speaking of discipline, let's talk about a market that seems to have absolutely none of it when it comes to corporate governance, South Korea.
Oh boy, the Korea Value Up program. It was supposed to be the mirror image of Japan's reforms. Fix the Korea discount, force chaebols to respect minority shareholders. How is that going?
In a word, terrible. While Japan is celebrating wage hikes and stock buybacks, the KOSPI is flat year to date. And the culprit this week is, surprisingly, Samsung C&T.
Samsung C&T. That is the key holding company for the Lee family, isn't it? If they don't play ball, the whole Value Up initiative is basically dead on arrival. What did they do?
They did exactly what cynical investors like me expected. Yesterday, the board unanimously rejected an activist proposal from a coalition of UK and US funds to buy back $1 billion in shares. Their excuse? Need to preserve cash for future M&A amidst global uncertainty.
Classic. Future M&A is the oldest excuse in the book for hoarding cash. Meanwhile, the stock is trading at a 60% discount to its net asset value. It's frustrating because we just saw Japan's Mitsubishi Corporation burn 10% of its market cap in buybacks last year, and the stock doubled. Why can't Korea learn?
Because in Japan, the corporate governance reform is driven by the government and the exchange. In Korea, it's still fought tooth and nail by the chaebol families who fear losing control. I saw a quote from a CLSA analyst that summed it up perfectly. In Tokyo, the shareholder is king. In Seoul, the shareholder is a nuisance. Until that changes, the KOSPI is uninvestable for long-term value funds.
Ouch. Uninvestable. That is a harsh verdict for an economy with so much tech talent. But speaking of tech talent disrupting old industries, let's fly south to Bangkok. The Detroit of Asia is turning into the Shenzhen of the South.
You're talking about the Thai auto market. For 40 years, this was a Japanese fortress. Toyota, Isuzu, Honda, they had 90% market share. You walk down the street in Bangkok and every pickup truck was a Hilux or a D-Max.
But not anymore. I was looking at the January sales data from the Federation of Thai Industries. It is shocking. Chinese automakers, led by BYD and Great Wall Motor, have captured 28% of the total market share. That is up from 0 just 4 years ago.
And it's not just small city cars anymore. That's the scary part. BYD just launched their electric pickup truck, the Shark, in Thailand. I heard early orders are outpacing the Toyota Hilux Revo for the first time in the premium segment.
An electric pickup truck beating the Hilux? That is symbolic. The pickup truck is the heart of the Thai economy. If Japan loses the pickup segment, they lose Thailand.
They are losing it. I spoke to a dealer in Rayong who sells both brands. He said customers are walking in, looking at the Toyota, seeing the analog dashboard and the diesel engine, and then walking over to the BYD with its rotating screen and V2L, vehicle to load, power supply, and asking, why is the Japanese car more expensive?
It's the Nokia moment for Japanese autos in Southeast Asia. They have the reliability, but they don't have the product. But Alex, Toyota isn't standing still. They announced that new IMVO platform, the $10,000 truck. Is that enough to hold the line?
It's a good attempt at a defensive moat, going ultra cheap to keep the commercial buyers. But the aspirational middle class in Bangkok, they want EVs. And right now, EV means Chinese.
EV means Chinese. That is a sentence that will keep Japanese CEOs awake at night. But wait, there is a twist in this narrative.
There is, and it brings us to our contrarian corner.
All right, Alex, what is the consensus truth that you are ready to dismantle today?
The consensus is that Thailand is becoming a Chinese EV colony. Everyone sees the BYD factories and assumes it's game over for Japan.
And it's not?
I think that in 2026, Thailand is actually becoming the geopolitical hedging capital of Asia. Yes, the Chinese are building EVs, but look closer. Japanese companies are quietly pivoting to hydrogen and hybrids for commercial fleets, which still dominate the rural economy.
So while the Chinese win the urban consumer, the Japanese keep the industrial backbone. That makes sense. The grid in rural Thailand can't support 100% EVs yet.
Exactly. The contrarian bet is that Thailand will be a dual system economy. Chinese EVs for Bangkok elites, Japanese hybrids and hybrids for the working class and logistics. It's not a winner-take-all market. It's a segmented market. Don't sell your Toyota Tucson stock just yet.
Interesting. The dual system economy. Okay, let's wrap this up with the action items. What should our listeners actually do on Monday morning?
Action item 1, buy GRAB, G-R-A-B. The dividend announcement changes the investor base. Income funds and value funds will now have to look at this stock. The downside protection is real, and the upside from fintech is free.
Action item 2, avoid Korean chaebol holding companies, Samsung C&T, SK Inc. Until we see a genuine hostile takeover or a regulatory hammer, the Value Up program is just a slogan. Stick to the operating companies like SK Hynix, where the earnings are transparent.
And action item 3, for exposure to Southeast Asian growth, look at Thai industrial real estate, WHA Amata. Whether it's a Chinese EV factory or a Japanese hybrid plant, they all need land in the Eastern Economic Corridor, EEC. It's the pick 'em shovel play on the auto war.
Great insights today, Alex. We covered Grab's historic dividend, the failure of Korea's governance reform, and the nuanced battle for Thailand's auto market.
The landscape is shifting fast. Next week, we're diving into the Vietnam chip ambition and why Intel is doubling down on packaging there despite the power issues.
I'll bring the power grid data, you bring the skepticism.
Deal. Thanks for listening to Asia Tech Macro. Don't forget to subscribe on Spotify or Apple Podcasts and leave us a review.
Stay data-driven. See you next week.
Bye.
Bye.